use
Dennis.
phone after joining the webinar.
Okay.
You guys have done that? It says, before you use your phone, you must select use phone after joining the webinar.
Okay. You select use phone.
I think you default.
And only using the numbers below it. Audio pin shown after joining the webinar.
Yeah, I know.
Webinar ID number.
Hey, Dennis. Hey.
That's not what I was
So
expecting.
many things are happening right now.
Like what?
I don't even know.
Okay.
Hello.
Hey, Dennis.
Hi.
Hey. Is that, I think, all right, I think we lost the echo. No. So I think you're on, oh. Are you there?
Yes,
Perfect. That sounds better. All right, good. Now it's just,
I'm
we
here.
got one instance of you now.
I'm gonna put myself on mute, I guess.
You can leave it open for right now if you want to talk
Okay.
to us.
All right.
Ian's here. And then you'll be fine. We can organize who's muted and who's not on this side.
Can we try it with a mute though? Because we can't mute him on his end unless he puts in the pin. Dennis, can you try to mute yourself now?
Sure.
Okay, and then say something. Hopefully we can't hear it. Okay, and then if you can still hear me, go ahead and now unmute.
Okay, I'm
Okay.
back.
That sounds
So-
great.
So Debbie, at the end, is someone gonna pass it on to me and tell me?
Yeah, I will do that. Yep. I'm going to come in right at the end and say, hey, it's been great. We've covered everything we need to cover. And now I'll turn it over to Dennis for some closing
All right.
comments.
Okay, super.
Cool. Easy enough. Got Dean. I know Jerry and Tom are heading over. And then Scott should be dialing in here pretty quickly. So
Terrific.
it looks like Scott's hopping on. So
Now, we don't have the slides with the information about the partners, the order in which I'm going to be talking about them, right?
they are, yeah. The script that I gave.
No, I'm sorry. That they are, and I checked that, but they're not going to speak in the order in which we are going to introduce them.
Correct.
Because
Correct.
Tom will be the first one to kick off.
Correct. Yeah.
Okay.
So they're just there to introduce all four of them, and then. Hello, everyone. Thank you for joining us for today's webinar on tax reform, what you need to know as a board director. We're proud to partner with the National Association of Corporate Directors, the Northern California chapter, on today's webinar. And you'll be hearing from Dennis Wu here in just a moment. But first, I've got a few housekeeping items to cover before we get started. Let's start with how you need to use that webinar pane. You can maximize or minimize the webinar pane during the presentation by using the red or orange arrow buttons. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a question box that you can use to type your question in and click submit. We'll be answering those questions as time allows toward the end of the webinar. Next up are the audio settings. If you're using your telephone, please click on the phone call audio option, or if you're listening through your computer, then please click on the computer audio option. Now a quick review of some California CPE requirements. To qualify for CPE, you must use a personal computer, no smartphones, and log in with your own unique information and URL. You must be logged into our webinar software for at least 50 consecutive minutes within the scheduled time frame of the webinar, and you must actively respond to at least 75% of the polling questions. There are 4, which means you need to answer 3, and you must complete the evaluation survey at the end of the webinar. And a quick review of these learning objectives, what we're going to cover today, review the impact of the overall Tax Cuts and Jobs Act reform, discuss examples specific to issues most relevant to board members, and then evaluate some next steps for individuals and organizations as we enter 2018. And with that, I will turn it over to Dennis.
Good morning. I am Dennis Wu, the Chair, California Chapter ACD. We're extremely pleased to be able to present today's program on tax reform is here by Armamino. We have a few partners with us today to speak to you. Dean Kiambo is Armamino's Chief Relationship Builder, helping private, public, and nonprofit organizations address their tax, audit, and outsource accounting needs. Jerry Clancy specializes in taxation and business advisory services, assisting clients with strategic planning and taxation for C Corps, S Corps, partnerships, individuals, estate, and trusts. Scott Borgia specializes in consulting on complex tax business issues, including income tax matters and tax compliance among the public and private sector. And finally, Tom Bondi focuses his efforts on tax business advisory services, stock options, funded technology companies, and negotiating transactions. Since I'm sure you're anxious to hear about how the 2017 tax reform will affect you and your companies, let us get started. Tom?
Thanks, Dennis. Before we get started, and I turn this over to Jerry, wanted to just make an announcement to everybody that this is the most comprehensive tax law change since 1986. A primary difference in 86 is we had quite a few months to prepare for that act and well-versed with committee reports. This one, the practitioners and companies, advisors, directors will have very little time to get up to speed because many of these tax provisions have already taken place, have already started to take place, with a lot of major changes taking effect for 12/31/17 as well as January 1st. So we want to let you know that this is going to be at the 30,000-foot level overview. There's just way too much information to cover in 1 hour. But you need to plan on spending time getting to understand this bill. There are a lot of key areas to focus on, and we hope to touch on some significant ones for you this morning. Debbie?
Perfect. Before we get started, mention that CPE. We're going to get our first polling question underway. Which TCJA changes most concern you? Is it A, individual, B, business, or C, international? If it's something else, just enter it into that questions box and we'll make sure that we touch on it either during the webinar or after. Get those answers in. We'll close the polls in 3, 2, and 1. It looks like we're pretty evenly split between individuals and businesses. And with that, we'll turn it over to Jerry.
Good morning, everybody. Today I'm going to be discussing the impact on individuals and flow-through entities. You know, when I think of this this new tax act, I would like you to imagine a 10-story building and think of the old tax act as that 10-story building that got remodeled about 15 times. The new tax act, rather than demolishing the old building and building an entirely new building, simply adds about 5 new stories to the old building. So that kind of gives you some idea of what's happening here in terms of complexity. We're not simplifying the code, it's actually more complex than ever. So looking at individuals, we will kind of breeze through some of these items and then maybe dive deeper into a few areas. The first thing is that the individual tax rates have been reduced across the board generally. The thing of note there is the top rate dropping from 39.6% to 37%. One item to note is that people will ask me about the marriage penalty, and with the new tax act, the marriage penalty is still there, i.e. it is essentially penalizing in many cases to be married based upon how the rate bracket structure is set up. The standard deduction has been increased and essentially doubled to $12,000 and $24,000 for married individuals. And with respect to the deduction of state and local taxes, we are now allowed a whopping $10,000 combined deduction for state, local, and property taxes and income taxes. The AMT exemption has been increased for individuals, and what's interesting about that is one wonders, when would someone even be an AMT if the AMT exemptions have been increased, causing fewer people to be an AMT, and then state income taxes essentially no longer being deductible, state property taxes heavily limited, and also miscellaneous itemized deductions being limited. Who's going to really ever be an AMT now? And I guess one example of that would be someone that has an incentive stock option exercise. In that case, you could still have someone end up in AMT, but there'll be far fewer individuals in AMT than there were in the past. The new Tax Act eliminates the individual mandate penalty tax, so that's no longer around. On the medical side, the medical expense deduction is still allowed as an itemized deduction, and the percentage has been dropped from 10% down to 7.5% for a period of time. Charitable contributions are still deductible, and in fact, they've been expanded. So instead of charitable contributions being 50% of AGI as a limitation, that's been expanded to be 60% of AGI. The other area that's interesting is in the estate tax area. So the estate tax exemptions have essentially been doubled. So a married couple can transfer $22 million in value to the next generation, approximately $22 million, which is double what it had been. Here's the thing that you need to know about that, though. This is a temporary change. So this continues until 12/31 of 2025, and then it resets back to the pre-2018 level. So this is kind of important because this could cause individuals to want to go ahead and make gifts during this time frame because we're not sure what's going to happen at 2025, and ostensibly it would just be reset down. Mortgage interest deduction. So the mortgage interest deduction is preserved, and for existing mortgages is essentially unchanged at the $1 million. And you can carry that into the next year, and to the extent that you continue to have that mortgage, you still will be able to deduct the mortgage interest for indebtedness up to $1 million. Any new mortgages, the limitation is $750,000 in indebtedness. So you can only take mortgage interest on up to $750,000. And then one important note is that home equity loans and the interest on those is no longer deductible, whether or not the debt existed prior to 2018.
Jerry, I wanted to point out that if before you look at refinancing your home, it's a really important step to talk to your tax advisor before you enter into any refinancing, because that could have a serious effect on lowering the interest expense deduction. So please be sure you follow up with that if you're thinking of refinancing.
So let's take a moment and look at pass-throughs. We'll spend just a little bit of time in this area. One of the interesting parts of the Tax Act is, Congress was really struggling with, how do we sort of equalize the reduction in the corporate tax rate with flow-through businesses like partnerships and S-corps, and also then sole proprietorships. And there was much haggling back and forth between the House and the Senate as to how to accomplish that. And what they finally arrived at was this 20% tax deduction on certain trades or businesses. And essentially what occurs is that, if the business qualifies, the business's profits will get your taxable income will get a 20% deduction applied to it. So imagine a business that has $1 million of income. That business would then get a $200,000 deduction that kind of comes out of thin air. So what's the point of that? Well, what that does is effectively reduce the tax rate associated with that income from 37% to about 29%. It's essentially about an 8% rate reduction. That isn't as low as the corporate rate of 21%, but it begins to attempt to equalize that to some degree. The thing to note about this 20% deduction, though, is that it doesn't qualify for all types of trades or businesses. Certain businesses are specifically excluded from this. Accounting profession, legal, and other service businesses, other brokerage businesses. You know, one of the definitions is an all-encompassing definition that essentially says any business whose principal asset is the skill or reputation of one or more of its employees would not be eligible for this 20% deduction. Understand, though, that everybody is, all businesses, trades or businesses are eligible for this deduction up to some income thresholds that are applied at the partner or shareholder or sole proprietorship level. And that level is $315,000 for a married couple. So if your trade or business had $315,000 or less of income and you were married, and it's a qualifying trade or business, everybody would get that deduction. And so where we're looking at is, what types of things don't rise to the level of a trade or business. And one of the areas that we are studying right now is the area of real estate. So we're looking into this code to determine whether rental properties, for example, would qualify for this deduction. And we'll be getting some additional information on that as time goes on. One of the things that, when you look at the Tax Act, you get surprised in certain areas. And one of the surprises that I didn't even know was on the horizon is that the new act imposes another limitation on non-corporate taxpayers' ability to use pass-through losses against other income, like interest, dividends, capital gains, possibly wages. And what's interesting about this is that, pass-through entities already go through this gauntlet of limitations. It goes through a basis limitation. It goes through an at-risk limitation. It goes through a passive loss limitation. Well, now we have a new limitation called the excess business loss limitation. And essentially what this does is it prevents those excess losses, which the thresholds are $500,000 for married individuals and $250,000 for other individuals, to be offset beyond that against income from other sources. So, what this essentially does is cause us as CPAs to have a whole new series of calculations and really buckets to keep track of, similar to NOL limitations, similar to passive loss limitations. It really expands the complexity of the code in making these calculations.
Yeah, I think, Jerry, one of the things we want to point out is that for folks that are either responsible for partnership returns or are going to be receiving partnership K-1s for the year 2018, you're going to start now being required to receive multiple items of information from those partnerships. So if a partnership has flow-throughs that flow into that partnership, will be needing information like wages that flow through in order for the calculations to be done for that 20% deduction. So it's going to require partnerships to spend a lot more time in the assembly of their partnership tax returns in order to provide the information to the individuals at the individual partner level when they're making these calculations for the 20% deduction as well.
And then one last item that's not on this that I thought I would just mention is that alimony deductions rules have changed. And so it used to be that alimony was deductible by the person paying the alimony and was income to the recipient of the alimony payment. That will no longer be the case. It will no longer be a deduction. But here's what's important to know. The provision is effective for any divorce or separation instrument executed after December 31st, 2018, or for any divorce or separation agreement executed before 2018 and modified after that date if the modification expressly provides that the amendments apply to this modification. So it's a little complicated, but there's kind of a window of time there where divorce decrees could be set up to still get that deduction. So old divorce decrees get the deduction. These new ones will not. Thank you very much.
Thanks, Jerry. Now on to that second polling question. Everything that Jerry's talked about and Tom as well. Are you concerned about the individual changes? A, yes, B, no, or C, not yet sure. And get those answers in. And for those asking if you'll get a copy of the slides, yes, you will. I'll work with Lisa to send out a recording of the webinar as well as a copy of the slide deck after. Get those answers in. We'll close the polls in 3, 2, and 1. Looks like you scared about, half of the audience, so that's good. And now we'll turn it over to Scott Borgia on the corporate side.
Good morning, everyone. It's a pleasure to be with you all. So as Tom noted at the very beginning, there is some significant changes in this, what some believe is tax reform, but really that is still to come, but a lot of new rules. One of the primary items that I think most people have heard about is the corporate tax rate has been reduced from 35% to 21% beginning January 1st, 2018. This is really to bring the U.S. into a more competitive tax rate compared to other countries that have over the last few years really been bringing their tax rates down. So 21%, so for any calendar year corporations after 12/31/17, the rate will now be 21%. If you're a fiscal year company, the rates are blended in accordance to the period of time after 2018. So this is a great opportunity. We've been working with a number of our clients before year end, and certainly there still is room after year end to really examine where there is availability to accelerate deductions or defer income associated with 2017 so that you can get a permanent benefit. Deductions that can be at a 35% rate versus in 2018, they'll only be at a 21% rate. So that's a significant matter for companies to explore and see what they can do to achieve that. The result immediately for any companies with 2017 financials is that they will need to remeasure their deferred taxes to the new rate, to the 21%. What that means is there will be a significant haircut, about a 60% haircut in reducing those deferred tax assets from 35% to 21%. So that just needs to be anticipated. The CPAs, the corporate tax departments are very busy right now preparing to get all this done. The other element, as the federal rate is reduced, that actually pushes up slightly the state deferred taxes, which are net of the federal benefits. So as the federal rate has come down, that pushes up the net state deferred taxes slightly. So just be aware of that. Now, what happens to all the states? And this is where there will be much monitoring going on. A number of states in their provisions incorporate specifically any change by the federal is automatically conformed to. That is not what all states do. Some of them specifically have to enact as of a specific date that they have adopted the legislation. Some of that has not yet taken place. So we will see a number of states as they get around to figuring out what they're going to do in adopting some of it, all of it, how they will modify their tax returns to address how they will adjust for certain provisions of the federal that they are not going to follow. It's just going to become a large project for all these states to begin to deal with. Fortunately, for the most part, this is not impacting tax returns until 2018, but there is a lot to begin to sort out for those states to really determine how they're going to do this and what's the best way to go about it. As we move on to the next area, probably what many of you have heard about, corporate AMT has now been repealed starting in the years 2018. As mentioned before, the corporate rate has been reduced to 21%. The corporate AMT rate used to be a 20% rate. So really with the reduction to the 21%, the AMT rate is no longer of any value. Taxpayers who have paid AMT in the past and have what's known as AMT credits from having done that are allowed a means to recoup those AMT credits through either a reduction to liabilities in the years 2018 through 2020, with a portion of that then being refunded, or after 2020, it's then refunded in full. So that's a key item, especially for some companies that may have those currently on their financials, perhaps with what's known as a valuation allowance against those. There is the need to revisit how those credits may need to be recorded now, because there is true value to be received in the form of cash in the near future on those. Going to the provision of net operating losses, at the present time through 2017, companies that incurred operating losses had a period of 20 years in the future to use them, or could even carry them back 2 years. That has now changed. Starting in 2018, any NOLs incurred will only be allowed at 80% to offset taxable income. And as a result of that provision, that change, they will now have all NOLs starting in that are from 2018 will be carried forward indefinitely. So no longer a expiration period on them, but as well they have repealed the 2-year carryback law. So they've taken as it relates to the NOLs. NOLs that are pre-2018 are still allowed in full to offset taxable income, but just be very aware, starting in 18, that there is a limitation on how much can be used. As we go to the next area, we get into fixed assets and what has been done to further incentivize investment in capital. So starting, and they've picked the unique date of September 27th, 2017, starting at that date forward until 2022, through 2022, there is now 100% expensing allowed of qualified property acquired and placed in service. So for the most part, that will cover your personal and tangible property. So the fixed assets, the furniture and equipment, the machinery and equipment, the computer software, and that you will be able to, the corporations will be allowed to deduct them in full. After 2022, there is a phase down of that provision to 80 to 60 to 40% as each year goes out, and that after 2026, then the 100% expensing will be gone. One item to note specifically as a planning tool here then is companies may, to the degree they acquired a lot of fixed assets under that provision of post September 27th through the end of the year, it would be very favorable to expense the qualified property if the company's in an NOL, so that they can get an NOL that's at 100% utilization before that NOL goes to the 80% limitation. So it's just another way to try and maximize the benefit that otherwise can be limited in the following year.
Hey, Scott, this is Jerry Clancy. These business expensing provisions are also very similar in the flow-through and sole proprietorship area as well.
Great.
Yeah, and also the other comment I think on that is there is an election to elect out of the 100% expensing, and it's on a by grouping basis. So companies need to be very careful about determining which groups they elect out of this method, because it will be a year-by-year election, and they'll need to do that for managing their cash flow as well.
Excellent. Okay, we'll then go to interest. So starting in 2018, though there have been some provisions previously in certain limited situations to limit the deductibility of interest expense, they were known as the earnings strippings rule. There is now a more broader limitation on the deduction of business interest. So this can be significant for a number of companies, obviously, that are using debt to build their business. So under this limitation, the deduction allowed for the business interest cannot exceed the sum of the taxpayer's business interest income plus 30% of the taxpayer's adjusted taxable income. Adjusted taxable income is taxable income computed before deductions for depreciation, amortization, and any NOL deduction. So there can be a significant limitation perhaps now on companies, depending on the extent of their taxable income, how much interest will be allowed in any one year. Any disallowed interest under that calculation can be carried forward indefinitely. So it will then just create a carry forward that, depending on the size of those interest amounts that are being deferred, can obviously become then a much larger and larger deferred interest deduction, and at some risk at some point of when will those amounts ever become deductible. There is a small business exception for companies whose average gross receipts are less than, for the prior 3 years, or less than 25 million. So that's something that at least provides a little window for companies that are in their early stage to not yet have that provision apply. Another one that perhaps you've heard a lot of, especially as you sit on the boards of the various companies, is the changes made to what's called the Section 162M rules. And 162M is that which deals with the officer's compensation limitation for deductibility to $1 million. So what they've done in the new rules is, one, they've expanded some of the definition around who is a publicly traded company or subject to these provisions. And in that, they've also expanded the definition of the covered employees. And those employees now that are subject to this provision include the CFO, along with the CEO and the 3 most highly paid officers of the company. And then once you are a covered employee, you will continue to be a covered employee, so that the number of people covered, depending on how those 3 highly paid officers may vary over time, that may grow to a larger number of covered employees. One of the key provisions here is they have repealed the exception for performance-based compensation and commissions. Where that really has an impact as it relates to taxable compensation is in the stock option area. So where a lot of officers may have been able to exclude their significant income associated with the exercise of stock options, non-quals or ISOs, now those amounts are outside of the they are not included as an exception. And so you have potentially a lot more of officers' compensation that is going to be limited to a $1 million amount per individual per year. Now, there is a transition rule for compensation paid pursuant to a plan under a written binding contract that is in effect as of November 2nd, 2017, and which was not modified in any material respect after such date. There are a lot of rules around what is truly qualified under that transition rule, and we strongly recommend that the company consult with their legal group, their legal advisors, into the determination of what is subjected compensation, so that hopefully you can still have much of the officer's compensation eligible for full deduction under the transition rule. And otherwise, you'll begin to really see some large limitations on officers' compensation.
Thanks, Scott. This is Tom. One of the comments I would just want to make regarding the 21% corporate tax rate is just an advisory to everybody that if you're working with S Corps, partnerships, LLCs, please don't rush into converting to a C Corp. There are a lot of different issues that should be considered. So please turn back to your tax advisors to study whether that's an effective election to do or not. Don't just scramble to get the 21% rate. It could have adverse effects throughout your organization if you're S Corp, LLC, or partnership. In the area of stock options and stock grants, we continue to see a great deal of problems in this area, both the private companies, earlier stage, as well as even at the public company areas. And so I just want to remind you the areas that include for equity and compensatory type options are in the areas of stock grants, where you're transferring actual shares of stock to an individual, may be potentially subject to compensation at that time, or there might be tax effects that come in later if there are restrictions on those, and we'll talk a little bit about that. There's restricted stock units, which means there's a grant typically of a certain number of units of shares that typically will vest over a period of time. Then we have non-qualified stock options, also known as non-quals or NSOs. Again, those are compensatory type options that when they vest, they still have to be exercised, although a lot of people do have early exercise capability. The incentive stock options, which continue to have AMT implications if exercised, and just a warning there that if for companies as well as individuals, for employees that have ISOs, when you do an early exercise on an ISO, it does create a lot of pain for both the individual and the company if you're doing an 83B election, since 83B is not applicable for regular tax under an ISO, but it is for AMT. So please get advisory on that. And acceleration of vestings upon exits can cause some tax effects that companies as well as individuals should be aware of. So please be sure to get tax advisory when you're considering on an M&A deal to do an acceleration of options. Now we have the typical general rule is Section 83A, which basically says an individual does not have to pick up the tax attributes associated with a stock or stock issuance or stock option exercise unless under Section 83B they make an election within 30 days of receiving those shares that they elect to forego Section 83A and recognize the tax attributes associated with those shares at that time. And the reason for doing so is so that the idea is that on an ongoing basis, the growth in that stock could become capital gain, ideally. With the new tax law, we now have a new Section 83I. Now, Section 83I generally applies, in fact, it only applies to employees. There are some employees that are disqualified employees, but they must be employees of the company, and specifically applies to RSUs and to non-qualified stock options. There's an election that has to be made if the employee chooses to take advantage of Section 83I, but the company, effective January 1st, 2018, the companies, when they're granting options under RSUs, or I'm sorry, restricted stock units, when they're granting those, or they're granting non-qualified stock options where there is a receipt and a transfer of the shares itself. So for example, an RSU gets transferred over to an individual or a non-qualified stock option gets exercised, the companies now have an obligation to inform the employees that they may benefit from an election under Section 83I. It must be made within 30 days of the transfer of shares just like an 83B does, but you're going to want to have your companies get up to speed on this 83I because it takes effect January 1st, 2018. In addition, individual employees that have ISOs that do an election, they may do an election under 83I, and the benefits or detriments, it depends on your situation, of doing this election only defers potentially the recognition of income, ordinary income, for federal and state income tax purposes, but does not give a deferral for FICA and Medicare purposes. And again, if you do an election for an ISO exercise and you elect to have it treated as an 83I election, it will treat that ISO as if it was a non-qualified stock option. Okay, an 83I, one last thing, is not allowed where an 83B election was filed on those shares. So there's a great deal that's going on in this area. As a board member, you're going to want to become aware of this. It's going to require cash flow necessity on the part of the company. So you're going to want to get some tax advisors to help you through this maze. Lastly, I want to just comment on the carried interest for those of you that have carried interest in venture partner groups. The rule for carried interest now requires that an involvement or holding of those investments for a period of 3 years before that carried interest will receive long-term capital gain treatment. So again, you're going to want to pay attention to those special tax attributes. Scott, back to you.
All right, thanks, Tom. So meals and entertainment expenses, there's been a lot of change there. As it currently stands, taxpayers can deduct 50% of business meals and entertainment and 100% of meals provided through an in-house cafeteria or meals provided by the convenience, for the convenience of the employer. However, under new rules, the deductibility of entertainment, amusement, or recreational activities, even if directly related to active conduct of the taxpayer's business, has been repealed. So entertainment expenses, in essence, will no longer be deductible. They've also repealed the deduction for the qualified transportation fringe benefits. And then they have reduced, as it relates to the in-house eating facilities or for meals for the convenience of the employer, they've reduced the deductibility of that from 100% to 50%. So some significant changes in that regard. You know, I think people would see that in getting the 21% rate, that there is then some haircutting of certain deductions that otherwise have been allowed in the past. So meals, entertainment expenses certainly affected.
Perfect. Thanks, Scott.
Oh, yes, please go.
Thank you. So we've got our third polling question here, again, for those here for CPE. Given all the information you just received, are you concerned about the corporate changes? A, yes, B, no, C, not sure. And as a reminder for those who have those questions sort of sitting, please do enter them in the questions box. As we've got time, we'll try and answer them toward the end or following the webinar. Get those answers in. We'll close the polls in 3, 2, and 1. Looks like Scott and Tom did a little bit better of a job of scaring some folks with the corporate changes. And we'll move on to some international issues.
International, I'm sure many of you have heard some of the changes that are coming, and not minimal in any regard. So some pretty significant changes. In essence, what is happening here is where currently companies have been able to, as it relates to their foreign operations, until those funds were brought back to the U.S., they weren't taxed, but on repatriation or dividend, they would then be taxed, and thus many companies, as you're all aware, have kept their earnings offshore, not bringing them back to the U.S. and avoiding the taxation at pretty high rates, and that has now been changed. Going forward, there will be 100% dividend received deduction on earnings that are brought back to the U.S. There is no foreign tax credits that will come along with those earnings as well, since those are not going to be taxed. So a big change there, with some exceptions, as we'll get into. As I'm sure all of you have heard, there is, in the implementation of this change, there is a one-time mandatory inclusion of untaxed foreign earnings that currently exists. Whether those earnings are brought back or not, in essence, it's a deemed repatriation of all untaxed foreign earnings, and that tax will apply to a company's earnings and profits that are calculated on a cumulative and aggregate basis for all the foreign subsidiaries. And looking at that, there then will be a distinction in the rate applied. There will be a 15.5% rate on cash assets, and there will be an 8% rate on the remainder. There will be allowed some offset of that for foreign tax credits that exist. For companies and NOLs, they still may be able to offset any real cash tax due from this. So it will vary depending on just the taxpayer's circumstances. Any tax under this one-time mandatory inclusion, the taxpayer may elect to pay over a period of up to 8 years. So there is a means to spread that cost as needed. But this is a huge area right now for a lot of companies immediately to deal with, because this is a 2017 tax return calculation. So as it relates to any year-end provisions going on to prepare for the earnings release that are coming shortly, companies have to get this calculation done, and there's a lot of work being done to do that calculation and see what that tax is. In the change from to this territorial system, as we said, and again, avoiding, for the most part, offshore earnings being taxed by the U.S., there are a couple exceptions to that. The one that has been discussed in part is called the GILTI tax. This is for foreign corporations, foreign subsidiaries with what's called global intangible low taxed income. Now, what does that mean? It's somewhat unclear in that description, but it really means is to the degree a company has income over a deemed allowable investment return on their tangible property. So if your foreign entity doesn't have a lot of tangible property, it will have this deemed income percentage, and in looking at how much of that income is then taxable under GILTI, if the company in that foreign location has a tax rate of less than 10.5%, then there will be a provision to pull that income over any return allowed for fixed assets that they hold. That amount will be pulled in as a U.S. taxable income. So it does have a consequence to companies who are having still foreign entities in low tax rate jurisdictions with potentially little physical property there. So it still has to be looked at, and it's another area that a lot of the accounting firms are still trying to get their arms around, because there is not yet as much definition and detail around how the rules will apply and how it will be applied for income tax provisions as well. The other side of that, a favorable one, is on the domestic corporation, those that have what's called foreign-derived intangible income. So there will be a benefit for those corporations in that instance to get some of their income eligible for a lower tax rate than the 21%. This really replaces what existed before in other U.S. export-dependent benefits. There used to be what was known as the Section 199 deduction for domestic production activities. That has now been repealed, and in essence, this provides some of that benefit still to corporations that have significant high-margin foreign sales, and there will be an effective tax rate on this of about 13.125%. So two new provisions that have a lot of complexity around them. Yes, we're not getting simplification out of this act, but stay tuned on how these will be applied by your corporations as more details come out on that for the 2018 returns. The other provision to be aware of is what's called the Base Erosion and Anti-Abuse Tax, or BEAT, as they've said. We love to come up with some great acronyms for tax. So we have the BEAT tax. This is a new tax on corporations that make significant deductible payments to certain foreign-related parties. So in principle, similar to what the alternative minimum tax used to do, this is aimed at taxpayers that, through these payments made to certain foreign-related parties, were reducing their U.S. tax liability to let's say, to zero, and being able to minimize then what was taxable and that what tax they would pay in the U.S. So this now institutes a minimum tax. The BEAT tax in 2018 will be 5%. It goes up to 10% for 2019 through 2025, and then 12.5% for 2026. This is only applicable for corporations that have average annual gross receipts of $500 million. That's looked at on a group basis, so you have to reach out to the members of your group to calculate that $500 million. So it's maybe not applicable for a number, but it can certainly catch the larger corporations. Just to finish up on what this means in the financial statement world, as I said before, there is a lot of work going on right now associated with the income tax accounting and the tax provisions that are needing to be done to finalize earnings for upcoming earnings releases. Because the law was signed into place before the end of Q4, it is applicable in Q4, and thus has to be reflected in these in the year-end calculations. The biggest impact, as I noted, will be having the deferred tax assets reduced to reflect the 21%. But in addition to that, to calculate the transition tax, to anticipate some of the other consequences, all those things are needing to be done in time to release the company's earnings. It's interesting as it relates to that, given that there is still a lot of uncertainty, as well as trying to gather all the information to do these calculations. The SEC issued SAB 118 just before the end of the year that actually provided guidance to companies where the information is not yet fully available in order to calculate the tax provisions. And they are providing, in some instances, the ability to use a reasonable estimate where otherwise the information is not yet available, or in some instances even to be able to state the company does not yet have the means to do a reasonable estimate, and so will be allowed to defer on that until a future point in time. So very interesting to see how that will be applied by all the the companies and their auditors, but a significant area as companies try and reflect in their financials the new tax law.
Perfect. Thanks, Scott. We're back to our fourth and final polling question. If you've missed one, make sure you make time to answer this one. Are you affiliated with an organization with international operations? A, yes. B, no. Get those answers in. We've got some time for a couple questions here at the end. We'll close the polls in 3, 2, and 1. Thanks all. And a quick review before we get to some questions on what we've talked about today. We've reviewed the impact of the Act overall, discussed examples specific to issues most relevant to board members, and evaluated some next steps as we move into 2018. And with that, I'll turn it over to Tom and some of our questions.
Thanks, Debbie. Let's see, some of the questions we had, one was, will individuals still be able to deduct business-related expenses for startups? I think what this question relates to is if you're the founder of a company or a group of founders and you have either, and you're expending a lot of dollars on research and development type expenditures for companies, there has been a change in the Section 174 area that now requires, instead of expensing, now requires 5-year amortization in those types of expenses. So you're going to want to get some advisory on what expenses those qualify for, as well as how to treat them for your company in that area. The R&D credits are still available, however, so you're going to want to pay attention to those. And R&D credits can be quite valuable for early stage, especially where you have refundable cash on payroll taxes. So if you haven't looked into that, you want to make sure you do that. The second question had to do with if it's an online business with less than $5 million in revenue and flexibility in structure, is there a corporate type LLC, C Corp to optimize tax changes? Unclear from just the question, because again, you don't want to rush into being a C. Typically, obviously, if you have funding, venture funding, angel funding, where you have convertible debt coming in, or series preferred series funding, it's always, or most often, most beneficial to be a C Corp so that those losses don't get lost by being distributed out to shareholders or owners that can't take advantage of it because they have no basis, and you want to preserve those losses inside the corp. Having said that, if you're an S corporation, LLC, you don't want to rush again. You don't want to rush into being a C yet until you've determined what's my path. If I'm looked down in the path the next 2-3 years, what's going to happen with this company? Because once you make that conversion to C, if you did not need to make it, then you struggle with how do we get money out of the company, and there could be some adverse tax issues in that area as well. Another question was, talk a little bit more about 83I and what circumstances it would be most beneficial. 83I relates to non-public companies, so they're private companies, and in what areas would they be beneficial? It relates to a deferral of recognition of ordinary income by the employees that are receiving these. So you have to make a judgment call as to the timing of when the vesting will occur, or when the transferability, free transferability, which means when can you adequately sell those. This is for, again, for private companies, so not public. And so you're going to want to evaluate, the employees are going to want to evaluate the timing on whether they should make an 83I election or not. I would encourage you to have individuals come in and do some training for first the board members as well as the employees of the company, so that they clearly understand what types of options or grants they have and how they should be treating it for tax purposes, so they begin to understand what 83I is all about, as well as 83B, since there's already a lot of confusion on 83B. So that's probably the words of wisdom I'd give you on that one right now.
Perfect. Thank you, Tom. And we've got about a few minutes left. I know Dennis wanted to hop back in and add some closing comments, so I'll turn it over to Dennis.
Thank you, Debbie. Thank you very much, Armamino Partners, for today's very timely presentation on the Tax Reform Act. NACD colleagues, we hope you'll join us in our future NACD programs, including our January 31st program on Boardroom Insights 2018 Consumer Electronics Show and its impact on boards. For more information, visit our website at northern-california.nacdonline.com. And that concludes our program for this morning.
Thank you, Dennis, and thanks again to our partners. Their contact information is up there on the screen. And again, I'll be working with Lisa to send a copy of the presentation as well as a recording following the webinar over the next couple of days. Thanks so much, and we hope to talk to you again soon.